How's everybody doing? Welcome back to another episode of the Banker Next Door. This is our weekly banking update for May 5th, 2024. And we're going to get into a whole bunch of news here right now. So let's kick it off with, let's talk about some of the economic indicators, things coming up this week. So let's hit this. So Tuesday, May 7th, we have the 3-year Treasury note auction. We get the consumer credit on Wednesday. We've got the 10-year Treasury note auction. On Thursday, we have continuing jobless claims. We have the initial jobless claims, and then we have the 30-year Treasury bond auction. So a lot of Treasury auctions on Monday, Tuesday, Wednesday, Thursday, and then Friday we get the Michigan consumer sentiment, U.S. Baker Hughes total rig count, and then we get the federal budget balance. So some pretty good economic indicators coming up this week. And speaking of treasuries, if everybody gets a chance, I saw a very interesting interview with former Dallas Fed president Richard Fisher that was on CNBC on Monday. And he basically said the biggest problem right now are the treasury auctions. And I could not agree with him more. And the thing that he was on Squawk Box, and the thing that was startling to me about this was he said the quiet part out loud. He said, obviously the treasury yields, when you look at the 2, the 5, the 10-year treasury yields, they are, 2 years ago, they were at 2% and now they're at almost 5%. That's obviously a much higher cost. And that gets into what they call the rolling of, CDOs, CBOs, LBOs, bonds, treasuries, all of this debt that has to constantly be rolled over year in and year out, coming in at those much higher interest rates. It obviously makes it much more expensive to do that. And it costs everything. It costs governments more, it costs companies more, it costs investors more, so on and so forth. But then shockingly, one of the interviewers there on CNBC goes, yeah, that's a good point. And we really haven't talked about that enough. And that's therein right there lies my criticism of CNBC in the last, 5 or 10 years. They just conveniently seem to miss these big major items and things happening in the economy, like the jobs report. They want to talk about the headline number. They never want to actually dig into the report and talk about what's really going on inside there. So that was a very enlightening interview. So if you have a chance to go check that out, go watch it. It's not very long. I think it's like 10 minutes, 12 minutes, something like that, but definitely worth checking out. Another very interesting article here from CNBC was called, that got published on Wednesday. And this was called "Why Hundreds of U.S. Banks May Be at Risk of Failure." So hundreds of small and regional banks across the U.S. are feeling stressed. You could see some banks either fail or at least dip below their minimum capital requirements, said Christopher Wolf, managing director and head of North American banks at Fitch Ratings. There was a consulting firm called Claros Group that basically analyzed about 4,000 U.S. banks and found that 282 banks face the dual threat of commercial real estate loans and potential losses tied to higher interest rates. The majority of those banks are smaller lenders with less than $10 billion in assets. Most of these banks aren't insolvent or even close to insolvent. They're just stressed, said Brian Graham, a co-founder and partner of Claros Group, as he told CNBC. That means there'll be fewer bank failures, but it doesn't mean that communities and customers don't get hurt by that stress. Graham noted that communities would likely be affected in ways that are more subtle than closures or failures, but by the banks choosing not to invest in such things as new branches, technological innovations, or new staff. So yes, I definitely agree with that. I mean, as you're seeing these pressures on banks, it's far more likely that they're gonna rein in their spending as far as like what they're spending on technology, what they're spending on employees, whatever growth plans they might have to open new branches. Like they might decide that, hey, we just want to focus on cost cutting and efficiency ratio and, making sure that our profitability stays strong and that our profit margins are really strong. Like they might decide to focus on that as opposed to a kind of a strong organic growth strategy. You could look at it that way. But yeah, it's very interesting. But I would also argue that while, yes, you may have these 282 banks that face a dual threat of real estate and potential losses tied to higher interest. I think those problems are much more acute, and we'll see this for a minute when we get into the numbers. I think those problems are much more acute for your larger banks and for your larger regional banks in this country, because they're the ones that have these, super large real estate books of business where they have office towers in urban settings. They have the buildings that are 100 million, 200 million, 250 million type mortgages on these buildings. They're the ones that have these massive, 10, 15, $20 billion bond portfolios that are currently underwater because of higher interest rates. Those problems, the larger the bank you are, the larger the bank is, the more acute, the larger and more acute those problems are going to be. Yeah, sure, there's some smaller banks that have to deal with things just like the bigger banks do, but I just feel that these problems are more acute to the bigger banks as opposed to these smaller banks. But again, very interesting article nonetheless. And I think I said, I think the article does make a very good point that these banks are stressed. Yes, they are absolutely stressed. So something we'll have to keep an eye on. So, okay. So what was the big news of the week? The big news of the week was the FOMC update. So the FOMC had their meeting on, I think it was Tuesday and Wednesday, and they basically announced, as anticipated, that they were not going to change interest rates at all. They kept the benchmark range at 5.25 to 5.5% for the sixth consecutive meeting. The Fed stated there was a lack of further progress toward the committee's 2% inflation objective, implying they will remain on hold until economic data confirms inflation is decreasing. The Fed also announced it will slow its pace of quantitative tightening beginning June 1st, lowering the cap on the amount of Treasury securities rolling off the balance sheet to $25 billion each month from $60 billion. So in other words, they are going to start to reduce their quantitative tightening. They've been trying to run off some of the money on their balance sheet, but this action has been hurting the Treasury markets. It's been hurting the sale of bonds, and we can see here by the way the market reacted that at least the bond and Treasury market, the 10-year Treasury ticked 5 basis points lower as soon as they announced this, which means that they liked it. They basically said, oh, okay, this is good. This is going to kind of help us out here. So that not the reduction of interest rates or the fact that they held rates steady, but the fact that they are going to reduce their quantitative tightening, that was the biggest takeaway. That was the biggest thing from this Fed meeting. Now, the market is still pricing in a 43% chance of a 25 basis point rate cut in November at the FOMC meeting. But, again, outside of a total collapse in the market, I really have a hard time believing that there's going to be any rate cuts this year. And here's the crazy thing, like even if you do have rate cuts, the higher Treasury yields they're going to keep interest rates elevated because again, the Treasury, in other words, the federal funds rate, like I could literally see a scenario where the Fed reduces the federal funds rate, say from 5.5, now you're down to 4. But your 10-year Treasury is at 8% because those Treasury yields have to be high enough that they can actually sell the Treasuries. Because right now you have a situation where China and Japan's not buying, and the U.S. government is stepping in. The Fed is stepping in, the Treasury stepping in to buy these Treasuries because they're having a hard time selling them. Because it gets back to standard risk and reward. If you're going to take more risk, which the dollar is viewed as more risky because the amount of debt and the amount of money that we're just printing right now, so there's more risk around the U.S. dollar. Therefore, there's going to be a higher reward. Like you're going to demand, people who buy it are going to demand higher interest rates. It's just what is going to happen. And so the Fed's going to have a hard time managing this. So and then it says here just a couple other things to note. So the policy vote was unanimous. The Fed reaffirmed it does not plan to cut rates until it gains greater confidence and inflation is moving sustainably toward 2%, which I keep saying that they will never get to 2% as long as our government continues to spend money the way that it is. The Fed noted economic growth is expanding at a solid pace with strong job gains and low unemployment. Depends on what you think of the unemployment numbers. Officials maintain the pace of runoff from mortgage-backed securities at a maximum of $35 billion per month. So we'll continue to eye what happens there. But then here's some other interesting things, some other interesting news that came out this week. So Wages and benefits growth deal yet another blow to the Fed in the inflation fight. So, an index measuring employee compensation grew 1.2% in the first quarter, more than economists expected. The Federal Reserve keeps a close eye on wage growth as it can fuel inflation. This is the latest economic data showing inflation and its contributing factors are running hotter than economists and investors expected. Employee compensation growth was good for employees in the first quarter, but it was a bad sign for the Federal Reserve's fight against inflation. So there you have it. So inflation is definitely staying higher. And then we had the jobs report that came out. So April jobs report was lower than expected. So that the job market slowed in April, adding fewer jobs than economists had expected. While the 175,000 jobs added isn't especially low by historic standards, it breaks a streak of hotter than forecast job reports. A slowing labor market would take pressure off inflation and encourage officials of the Federal Reserve to cut interest rates, putting downward pressure on borrowing costs for all kinds of loans. Stocks jumped following the jobs report amid investor optimism about numbers that were neither too hot nor too cold. And then it also says in here, employers added 175,000 jobs in April, a slowdown from the upwardly revised 315,000 jobs created in March, from the Bureau of Labor Statistics said Friday. And here's the thing to remember too. 1 month does not a pattern make. And so, who's to say that next month it doesn't come back and we've got another 250,000 jobs created in next month, or maybe it comes back and says, we only created 100,000 jobs. So you have to give these things 3, 4, 5 months to see kind of what is the trend line that is forming there. Have we really kind of broken through? Are we going to start to generate less and less jobs each month? What is that job growth going to look like? I mean, that's what you have to really look at. And I would say that the jobs numbers would have to continue to get weaker and weaker for a number of months before the Fed would consider reducing interest rates. Like even 2 or 3 months, if the jobs are 175, 150, 125, that shows a slowing job market. But does that really give the Fed enough ammunition to say, oh yeah, that we had 3 slow months in a row, so therefore we're going to cut rates? I don't think so. I think you're going to have to see a lot less of that. Now, obviously, if you start getting negative numbers, if you start getting that, not only did the economy not grow, but it contracted, we saw, job numbers, job losses of 100,000, 200,000 jobs in a month, then that's a different story. Then now you're talking about a collapse of the jobs market, and you're talking about the Fed now perhaps getting very aggressive with rate cuts. So like I said, we'll have to continue to keep an eye on it. The jobs market is a mess right now. It really is. And I think that, again, this in the immigration that's coming in is helping to fuel a lot of what's going on. But it's also the government spending as well that's keeping a lot of this stuff. Government is hiring a lot of people right now, and that's what's keeping a lot of people in. That's what's adding to a lot of these jobs. So again, I think there's a lot of smoke and mirrors right now in these numbers, and the Fed realizes that they need to do certain things, but they can't because if they admit to the fact that this stuff is not what they're saying it is, then they've got a credibility issue, and they don't want to do that. So okay, so let's get into some of the other numbers and things that are going on here. What do we got? So the Fed. What I kind of just talked about, the Fed expects more bank failures because hundreds of small and regional U.S. banks are feeling stressed, CNBC reported. We talked about that already. Lenders are buying back delinquent multifamily mortgage loans that they previously packaged into securitizations called commercial real estate collateralized loan obligations, or CLOs, to stave off trouble amid high interest rate, Bloomberg News reported. Lenders acquired $520 million of delinquent credit in the first quarter, up 210% from a year ago, the report said. So, here's the interesting thing. Banks had been trying to sell a lot of these loans recently to try to get this off the books. The question I keep asking is, why would you buy these loans? Like, I mean, if you're an alternative lender, you're a hedge fund or a private equity or whatever, and you're looking at these loans, like, why would you buy them? Like, I mean, seriously, if you're seeing a deterioration in rent rolls and tenant quality, expenses are going up, you have to renew the debt. Like, why would you buy these loans? I mean, it's like throwing yourself in front of the train that you see barreling down the tracks. I don't get it. Anyway, okay. A lot of news on New York Community Bank Corp and Republic Bank Corp. There was even an interesting article on Blue Foundry Bank Corp. So I actually just did an episode on all three of those banks. They got posted today with this episode. So if you want to check that out and get some more information on there, go check that episode out. Let's see here. What else we got? San Francisco-based Silvergate Bank, which is winding down its operations. That's one of the crypto banks that went kaput last year. Mentioned a $36 million provision for an unspecified potential regulatory penalty in a call report filed yesterday with FFIEC, according to an April 30th post on X. Former Binance Holdings CEO Changpeng Zhao, who pleaded guilty in November 2023 to violating U.S. anti-money laundering requirements, was sentenced Tuesday to a whopping 4 whole months in prison. Yeah, kind of amazing. Okay, Goldman Sachs is in talks to offload its General Motors GM credit card program to Barclays. The Wall Street Journal reported, citing people familiar with the matter. Barclays, which made a bid on the program in 2020, but had lost the business to Goldman, is the leading contender for the program this time and could ink a deal with GM by this summer. U.S. Bancorp and Bread Financial Holdings were among other potential suitors, but have recently withdrawn their pursuit. The GM credit card program reportedly has about $2 billion of balances outstanding. Banks that carry consent orders regarding their fintech partnerships are facing tough dynamics, striking a balance between the benefits of growth and the rising compliance costs associated with it. The business case for banking as a service, BaaS as they call it, remains strong, but banks should be wary of a fintech partner pursuing aggressive growth at the bank's sacrifice, industry experts said. So yeah, I'm going to be actually doing a whole episode on banking as a service because I think it's a cool thing. I think it's a cool niche in the banking business, but there are issues brewing, as you can see here. So okay, financial services trade groups joined congressional Republicans in opposing the Small Business Administration's plan of making direct loans under its flagship 7A program. American Banker reported, citing letters from the groups. So let's see here. What did they write in here? The committee says that direct lending by the SBA would drive up program costs and disincentivize 7A authorization within financial institutions. Right? Rebecca Renee, Independent Community Bankers of America President and CEO, wrote separately, the SBA direct lending is a poor and costly alternative to the private sector. Yes, I absolutely wholeheartedly agree. The SBA should not be a direct lender. The SBA provides guarantees on SBA loans that banks make. That has been their role forever, and that is as it should stay. Okay. What else do we got here? Okay, now let's get into some other stuff here. So Federal Home Loan Bank officials pledged to work with ICBA against harmful changes to the system. So yes, there was a conference ICBA was at, and it says during the chat, the officials discussed the role of the Federal Home Loan Banks as a source of liquidity for community banks. All 4 Federal Home Loan Bank representatives praised community bankers' efforts as advocates and supporters of local communities. With Donovan, who is Donovan? Federal Home Loan Bank's president and CEO Ryan Donovan, pledging to work with ICBA to prevent harmful changes to the system. So yeah, so the Federal Home Loan Bank is kind of under some pressure right now. You've got a lot of changes perhaps being proposed to the federal home banking system. I am not in favor of any of those changes. I think they were all extremely bad ideas. The federal home loan banking system, I'm gonna again, I'll do a whole episode on the federal home loan banking system, and I'm actually hoping to get somebody from the Federal Home Loan Bank on to do an interview with to talk about this topic. But the federal home loan banking system is so important and so critical to just the everyday operations and running of thousands of community banks across the country. To mess with them in a significant way is just a really, really bad decision, and it makes me cringe to even think that the regulators would be going down this road. But anyway, Okay, Fannie and Freddie published new policies on value reconsideration. So Fannie Mae and Freddie Mac published new reconsideration of value policies after collaborating with the Federal Housing Finance Agency and Federal Housing Administration. RVOs are requests from financial institutions to appraisers or other preparers of valuation reports to reassess the value of residential real estate. So yeah, I'm going to keep an eye on that one. Community banks continue to make efforts against fighting check fraud. Okay, construction spending drops in March. Construction spending fell 0.2% in March, but is still up 9.6% from a year ago, the Commerce Department reported. Manufacturing contracts in April. Economic activity in the manufacturing sector contracted 1.1% in April after March saw a gain for the first time in 16 months. FDIC and OCC detail merger proposals at House hearing during the House Financial Services Subcommittee on Financial Institutions and Monetary Policy hearing. Chairman Andy Barr raised concerns about the impact of regulatory burdens on community bank mergers and acquisitions. He also decried FDIC and OCC sluggishness in authorizing mergers that meet agency standards. I agree with that. Yes, yes, and yes. The FHFA reports rise in single-family guarantee fees. Yep. Factory orders rise in March. So new orders for manufactured goods increased 1.6% in March, following a downwardly revised 1.2% in February, the Commerce Department reported. Tennessee enacts a law barring credit union bank acquisition. Love it. It's great. Should bar that. So hopefully that will continue going on. Home prices rise, consumer confidence falls. Home prices increased 6.4% in February from the same time a year ago. Federal Housing Finance Agency's index of U.S. house prices rose 7% in February over the previous year, following a 1.2% month-to-month increase. And the Consumer Confidence Index fell for the third straight month in April, reaching its lowest level since July of 2022. Let's see here. What else do we got? CFPB says medical bills still showing up on credit reports. Personal income spending increased in March. Personal income increased 0.5% in March, and personal spending increased 0.8%. Consumer sentiment dropped slightly in the last month. So consumer sentiment dropped 2.2% in the last month, but is still up 21% in the past year. Okay, what else do we have to get here? So we got, so let's hit some other topics here before we wrap up. So home prices have reached a milestone. Home prices hit a record 383,000 during the 4 weeks ended April 21st, up more than 5% from a year earlier. So home prices getting more expensive. The cost of owning a car in the U.S. rising ever higher, complicating the inflation path. So it talks about like the cost of insurance, the overall cost of the cars, but basically it's gotten to like almost like the most expensive it's ever been to own a car, as well as to own a house, which is great. Two most expensive things you'll ever buy are more expensive than ever. That's fantastic. Okay, U.S. banks selling commercial real estate loans to get ahead of stress and diversity. We've talked about, and then what's interesting in this article is that the banks offloading are Pacific Premier Bank Corp, Brookline Bank Corp, Hilltop Holdings, Valley National Bank Corp. These are banks all looking to basically unload loans and try to get ahead of the credit issues. Repositioning of balance sheets leads to some swinging bank earnings. So banks that basically decided to bite the bullet and sell their underwater bonds and treasuries last year reaped basically huge profits at the beginning of this year, whereas the banks that decided to not sell and were hoping for just rate cuts, some of them are now getting pummeled. So again, I've reported on the underperformance and the unrealized losses in bank bond portfolios, but still interesting to keep a look on. So CRE credit quality cracks show in U.S. bank Q1 earning results. UMB Financial seals the largest U.S. bank deal since the end of 21 with their purchase of Heartland Bank. U.S. Labor Department head defends their fiduciary rule at House hearing. However, there's still a lot of litigation pending on that. Japanese banks likely to double down on U.S. treasuries as local rates rise. So a bunch of the Japanese banks are looking to buy more U.S. treasuries. I think that's good because that's kind of what we need. Total deposits in 2024 branch deals up $2 billion after Amerant's Houston sale. So basically, the amount of deposits that banks are selling and being bought by other banks is jumped here in 2024, which is already much larger than it was in 2023, which is good. U.S. regulators plan on finalizing the Basel III proposal by August. Still a lot of potential changes on the table, but I guess they are not going to repropose. They're just going to make changes to it and put it back out there. So we'll see what happens with that. U.S. banks eyeing smaller M&A deals in the face of industry headwinds. I guess so. U.S. regional banks grow deposits, but net interest margin pressures persist in Q1, just kind of things that we talked about earlier. And banking as a service players at a crossroads, weighing growth, compliance costs. And yes, I will talk about that in another episode. So, man, ton of stuff going on right now in the banking industry and the banking business. Never seems to let up for air for 5 seconds. Couple of other interesting episodes that I posted up today. I basically did, an episode on should banks be concerned about higher efficiency ratios. So, and then I also talked about how does higher for longer affect bank strategies? In other words, how do banks operate in this the current interest rate environment where interest rates are not coming down? They're basically staying higher, or even what I would call it a more normal range. But how are they dealing with that? How is that going to affect their strategies? Because obviously they have to pay. Banks they have a cost of funds. They have to pay up for deposits, and that's going to put pressure on profit margins. So banks have to balance their growth strategy against, what they're willing to pay for deposits. So couple of, like I said, thought-provoking episodes would be the best way to put it. Some of the other episodes and stuff that I just posted up on Thursday, I think it was, or Wednesday or Thursday, I posted up the latest 2 installments in the Lords of Easy Money. I basically have a production schedule, if you will, for that. I'm going to be posting 2 episodes a week for the next throughout the rest of this month to basically get that book done. We just finished up chapter 9 this week. I'm going to be posting the episodes on chapter 11 and 12, and then that will end part 2 of the book. And then I'm going to do a part 2 review, which will be a review of chapters 7 through 12. And then I'm going to come back. I'm going to do chapters 13 and 14, and then finally 15 and 16, and then that'll end the book. And then I'm going to do a final episode, the kind of a wrap-up review episode, where I'm going to do a direct link to what happens at the end of the book to exactly where we're at today. And I'm going to show a bunch of interesting charts and graphs in that video to line everything up so you can see exactly the effects of what the Federal Reserve did and how we got to where we are today. So if you're not following that Lords of Easy Money series, I highly, highly suggest you go watch it, because if you want to understand what's happening today in the market, if you want to understand how the Federal Reserve put us in this mess and how they've twisted themselves like a pretzel into this current predicament, you got to go back and you got to go read that book. You got to understand what's going on, because that book does a masterful job of explaining it. So, and then just another episode to point out, a couple other episodes, actually. I did, there was another episode that I just did, just kind of updating on New York Community Bank, Republic Bank, and Blue Foundry Bancorp. So if you want some more information on what's going on with those banks, the failure and the purchase last week of Republic Bank, go check out that update episode that I just posted today as well. And then finally, yesterday, on Saturday, I posted a conversation with Alan Berkeley. Alan's a good friend of mine. He's another banker that I have known for a long time. Very talented guy. Currently works for a bank called Tompkins Bank. And, Alan and I didn't really do an interview. We just did like kind of a conversation where it was a different format where we basically just talked about kind of a lot of the things that are going on in the banking world today. We basically talk about we talked about the failure of Republic. What does the Fed do with interest rates? What are kind of looking at the current jobs and GDP numbers and what do they really mean? So we get into some really good topics in that episode. So if you get a chance, go check that out. And then please check out, I did a couple of interviews last weekend. I did an interview with Brian Nestor from Nestor Insurance. And I also did an interview with Bob White, who's the CEO of First Colonial Bank here in Pennsylvania, and then they also have locations in Jersey. So if you and that was my very first bank CEO interview. So if you get a chance, go check out those interviews. And like I said, I think some really good stuff in those episodes. But I will be back next week with another banking update and a lot more information from you guys. A lot of episodes, I got a lot of stuff planned, a lot of stuff on the horizon here. A lot of things will be happening, I think, over the next 6 months as this channel and this podcast continues to evolve and take our next steps forward. So a lot of exciting things coming down the pike. But like I said, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave your comments down below. I always enjoy the people's comments and what they think about what's going on. And please make sure to check us out on YouTube, Rumble, and all major podcast platforms. And I will be back again. I hope everybody has a wonderful week. And I will see you. Like I said, keep an eye out on Wednesday and Thursday for the Lords of Easy Money episodes. And then I'll be back next weekend with another update. See you, everybody.